The Guardian of the Global Order, a comprehensive guide to Lockheed Martin LMT. As of March 3, 2026, Lockheed Martin Corporation, ticker LMT, stands as the preeminent force in the global aerospace and defense industry. In a world defined by the rapid evolution of autonomous warfare, the expansion of the space economy, and the modernization of nuclear deterrence, Lockheed Martin is no longer just a plane maker. It has evolved into a high-tech defense industrial complex that bridges the gap between traditional kinetic weaponry and the digital battlefields of the future. For an investor today, LMT represents a unique defensive growth hybrid. It offers the stability of multi-billion-dollar government contracts and a 20-year history of dividend growth, paired with moonshot upside and hypersonic missiles and AI-driven combat systems. This guide explores the company's 2026 strategic pivot, its record-breaking backlog, and the critical risks every investor must evaluate before starting a position this week. 1. The business model. The 4 pillars of defense. To invest in Lockheed Martin, you must understand its 4 distinct operational segments. In 2026, these segments are more integrated than ever before, operating under a unified 21st-century security strategy. 1. Aeronautics, approximately 40% of revenue. This is the home of the F-35 Lightning II, the world's most advanced stealth fighter. In 2026, the F-35 has become the Windows OS of global air defense, with over 18 allied nations currently flying the platform. Lockheed is now moving into the RT-3 phase, which upgrades the jet's computing power to handle advanced AI pilot teaming. 2. Missiles and Fire Control, MFC. This segment produces the stars of recent geopolitical conflicts, including the HIMARS, High Mobility Artillery Rocket System, and the Patriot PAC-3 missile interceptors. In early 2026, demand for these systems is at a 30-year high as nations across Europe and the Indo-Pacific look to harden their borders. 3. Rotary and Mission Systems, RMS. This includes Sikorsky helicopters, like the Black Hawk, and the Aegis combat system, which serves as the brain for the U.S. Navy's most advanced ships. In 2026, RMS is leading the transition toward digital shipbuilding, using AI to detect threats thousands of miles away. 4. Space, approximately 18% of revenue. Lockheed Martin is a primary contractor for the Artemis moon missions and the developer of the Next-Generation Interceptor, NGI, for missile defense. In 2026, the Space Force has become a major revenue driver as the company builds out the satellites required for global laser communications. 2. The 2026 catalyst, hypersonics and AI teaming. The most significant development for LMT in early 2026 is its leadership in the hypersonic arms race. The need for speed. Hypersonic missiles fly at over 5 times the speed of sound, Mach 5+, and are highly maneuverable, making them nearly impossible to intercept with current technology. Following a successful series of tests in late 2025, Lockheed Martin has secured the primary contract for the CPS, Conventional Prompt Strike, system. In 2026, this is transitioning from an R&D project into a high-margin production program. Collaborative Combat Aircraft, CCA. At the recent Global Defense Summit on February 12, 2026, Lockheed unveiled the production version of its Loyal Wingman drone. These AI-driven, uncrewed jets are designed to fly alongside the F-35, acting as sensor platforms or weapon carriers. This human-machine teaming represents a fundamental shift in how Air Force budgets will be spent over the next decade. 3. Financial performance, the backlog fortress. Lockheed Martin enters March 2026 with one of the healthiest balance sheets in the industrial sector. Key financial benchmarks as of Q1 2026. Record backlog. The company currently holds a backlog of approximately $165 billion. This means that even if Lockheed didn't sign a single contract today, it has enough work to stay fully occupied for the next 3 years. This provides revenue visibility that most companies in other sectors can only envy. Capital return. LMT is a dividend contender. On February 25, 2026, the board declared a quarterly dividend of $3.35 per share. The company has raised its dividend for 23 consecutive years, and at current prices, it yields a solid 2.8 to 2.9%. Share repurchases. LMT is aggressively cannibalizing its own shares. In the last 12 months, it has bought back nearly $6 billion of its stock, effectively increasing the earnings per share for every remaining investor. 4. Sector dynamics. The new Cold War tailwinds. Defense spending is inherently political, but in 2026, there's a rare bipartisan and global consensus on the need for modernization. 1. The NATO 3% goal. Following the events of the last few years, several European nations have pledged to move their defense spending toward 3% of GDP, up from the previous 2% target. As the largest defense contractor in the world, Lockheed Martin is the primary beneficiary of this $100 billion spending surge. 2. The Indo-Pacific pivot. With the ongoing build-out of the AUKUS alliance and regional tensions in the South China Sea, Lockheed's maritime and missile defense systems are seeing record orders from Japan, Australia, and South Korea. This international expansion reduces the company's dependence on the U.S. Pentagon budget alone. 4. Critical risks. What could derail the investment? Despite the record backlog, an investment in LMT carries specific systemic risks that you must understand. Fixed-price contract pressure. In late 2025, several of Lockheed's next-gen programs suffered from inflation-linked cost overruns. Because many government contracts are fixed price, if it costs more to build a rocket than expected, Lockheed has to eat the loss. In 2026, investors are watching the space segment closely to see if margins begin to recover from these inflationary pressures. The single customer risk. While international sales are growing, the U.S. government still accounts for roughly 70% of Lockheed's total revenue. If a future U.S. administration implements massive defense cuts to balance the national budget, Lockheed's long-term growth trajectory would be immediately threatened. The automation disruptors. In 2026, smaller Silicon Valley defense startups like Anduril and Palantir are competing for the AI and software portions of the defense budget. While Lockheed is a giant, it must prove it can innovate as fast as these software-first companies to avoid losing its digital edge. Supply chain fragility. High-tech missiles and jets require rare earth minerals and advanced semiconductors. In early 2026, global trade tensions have made the microchip supply chain volatile. Any disruption in specialized parts could lead to delivery delays on the F-35, triggering performance penalties from the Pentagon. 5. Strategy. How to invest in LMT today. As of March 3, 2026, LMT is trading near $595, having pulled back slightly from its all-time high of $515 reached in January. The core industrial approach. The buy-on-dips candidate. Because defense spending is long-term, LMT is often boring for months at a time. The best time to buy LMT is usually when the market is worried about Pentagon budget debates. These short-term headlines create short-term volatility that historically serves as an entry point for long-term investors. The IRA/401k anchor. Due to its 2.8% yield and low volatility, beta of approximately 0.65, LMT is a premier choice for tax-advantaged retirement accounts. It is a stock that zigzags less than the broader market, providing stability when tech stocks are crashing. The backlog to valuation rule. Currently, LMT trades at a forward PE ratio of approximately 17.5 times. This is slightly above its 10-year average of 15 times, reflecting the premium the market is now placing on defense and safety in an unstable world. For a new investor, starting a position here is a bet that the 2026 geopolitical premium is the new normal. Conclusion: the arsenal of democracy. Lockheed Martin LMT in 2026 is the quintessential hedge against global instability. It is a company that has successfully moved from being an iron and aluminum manufacturer to a silicon and software power. While it faces risks from fixed-price contracts and rising competition from tech startups, its $165 billion backlog and 23-year dividend history make it one of the most resilient companies in the Fortune 500.